Welcome to The Explainer. Today, we're setting up a massive showdown, a real clash of titans in the trading world.
All right, so in one corner, you've got the long-reigning champion, Mr. Stocks, backed by thousands of public companies. And in the other corner, we have the global 24-hour challenger, Mr. Forex, representing all the world's currencies.
So, the big question is, which market should you choose? Well, to figure that out, we're gonna put them head-to-head. We'll run through a few rounds, all based on our source material, and see who comes out on top.
Okay, let's get right into it. Round 1, the battle of choice. This is all about how many different things you can actually trade.
So, when it comes to the stock market, you're facing this just overwhelming number of choices. Think about it. Mr. Stocks brings a literal army to this fight. You're talking about thousands and thousands of different companies you have to research, analyze, and somehow pick from.
I mean, look at this number. Just between the two big U.S. exchanges, the NYSE and the NASDAQ, you're looking at over 5,800 stocks. Honestly, just keeping track of all of that, it could be a full-time job all on its own.
But now, look at Forex. It's a completely different story. Most traders, and the source material really highlights this, they focus on just 7 major currency pairs. That's it. It makes it so much easier to really keep an eye on what's driving the market without, getting totally lost in an ocean of options.
All right, ding ding, that's the end of round 1. Let's move on to round 2, fighting against the clock. Here, we're going to look at something super practical. When can you actually trade?
And this is a really big deal. With stocks, you're pretty much locked into the exchange's opening hours, right? Usually 9:30 to 4 p.m. Eastern. It's a sprint. But Forex is a whole different beast. It's a seamless 24-hour market. It literally runs from Sunday evening to Friday evening. It's a global marathon that you can jump into whenever it suits your schedule.
Okay, let's get down to the nitty-gritty. This next section is kind of a rapid-fire round, where we'll look at the actual rules of engagement, the core mechanics of how trading works.
First up, trading costs. Because, let's be real, nothing is free. Every time you make a trade, there's a cost. But how you pay that cost is totally different between these two markets.
Okay, so with stocks, you traditionally pay a commission, right? It's a fee for the service. Now, sure, some brokers are zero commission these days, but the classic model is commission-based. In Forex, though, it's different. You mostly pay through what's called the bid/ask spread. It's just that tiny difference between the buy price and the sell price. So the cost is basically baked right into the price you're quoted, which means most brokers don't charge any extra commissions on top.
Next, let's talk about market size and liquidity. Now, liquidity is just a fancy trader term for how much money is flowing through a market. Basically, it answers the question, how easily can I buy or sell without my own trade messing up the price?
And wow, just look at this number. The Forex market sees an average of $6.6 trillion in trades every single day. That is just a mind-boggling amount of money. It absolutely dwarfs the stock market. So what does that mean for you, the trader? It means there's always someone to trade with. You can get in and out of your positions pretty much instantly and at a fair price.
Okay, next up in our rapid-fire round, short selling rules. So, what happens if you think the market is going to go down, not up? That's what we call short selling. And the rules can be pretty different. So in the stock world, there can be restrictions. There's something called the uptick rule that can sometimes limit when you can actually short a stock. But in Forex, no restrictions at all. See, you're always trading one currency against another. So if you sell the euro-dollar pair, you're really just buying dollars with euros. It means betting on a market to fall is just as easy and accessible as betting on it to rise.
And for our final point in this round, market influence. The big question here is, how easy is it for a single big player, a huge bank or a massive fund, to manipulate the market?
Well, with stocks, it's definitely possible. A single large fund can cause waves, a biased analyst can move a stock price, and big corporate actions like IPOs can create a lot of volatility. But Forex, remember that $6.6 trillion number? Because the market is so incredibly massive, it's extremely difficult for any one bank or fund to really control a major currency. That size is its own kind of security blanket.
All right, that's the final bell. After all those rounds, it is time to check the official scorecard. So, who's the winner? Who came out on top in this matchup?
Well, if we look at the scorecard here, based on all the advantages we've talked about, Forex has landed some pretty heavy punches. You've got 24-hour trading, minimal commissions, just huge liquidity, and no restrictions on short selling. So based purely on these points, it looks like Forex takes the win.
But wait, here's the thing. The real winner, well, the real winner is the trader who picks the market that's the best fit for them. It's not about which one is better in a vacuum, it's about which one is better for your personal style, your goals, and your schedule. You have to ask yourself what kind of trader you want to be.
So at the end of the day, maybe the most important takeaway is this quote from Benjamin Franklin: "An investment in knowledge always pays the best interest." The ultimate question isn't really Forex versus stocks. The real question you should be asking yourself is, am I willing to do the work and learn what it takes to succeed in either of them? Because that's the investment that really matters.